Okay, so I do want to start by understanding where the 10 to 12% number comes from, because it isn't from thin air. Like there is some basis for it. So if we go back to 1950 in the U.S. through 2023, U.S. stocks have delivered a 11.32% nominal return. So not adjusting for inflation. That's measured by a total U.S. market index, or the return over that same period, 1950 to 2023, not adjusted for inflation, of the S&P 500 is 11.43%. So it's in that range, 10 to 12%, sure. And then for the last 20 years, the U.S. total market returns 9.81%, and the S&P 500 is 9.69%. So it's not hard to see where that 10%, around 10%, comes from.
That's in U.S. dollars, presumably?
Those are, that's a good point. All the figures I'll talk about are in U.S. dollars, just because.
And these are indices, not ETFs. These are pre-fee, correct?
Yeah, index returns. Yeah, not index fund returns.
But no cost in there, no withholding taxes. These are just raw
they're
index
gross, correct. U.S. dollar. We'll talk about real and nominal. The one numbers just now are nominal, but it's all U.S. dollars pre any taxes or fees or anything like that. Okay, actually that's a good time to mention this. I do want to talk about the difference between nominal and real returns. So the 11.3%, those numbers I was just talking about, those are nominal, no adjustment for inflation. That's kind of meaningless to talk about, though. And it's kind of meaningless because nominal returns don't feed you. They don't feed your family. They don't put food on the table. Real returns do. Inflation matters. People invest to fund their future consumption. And so I just want to give a quick example to explain why real returns are more useful than nominal returns. If we look at the 15 years ending April 1985, the U.S. market over that period did return 10.58% annualized. So we got that 10% on average number for 15 years. Great. But inflation over that same period was 7.05% annualized. So a huge portion of that return was gone. It wasn't a real thing. Wow. You didn't get to buy groceries with it.
And people, I think, misunderstand how impactful that is over long periods of time. Just yesterday, I was meeting with a client of mine, his daughter. She's 14, so really just a very novice level understanding of money. And so we just went through basics like debt, taxes, and inflation. And on, I think it's the Bank of Canada website, there's an inflation calculator that you can use, and you can look at historical inflation. And so she was born in 2010. So we just plugged in her birthday and put $100 in and said, what's that? What is an item that cost $100 the year you were born? What does it cost today, 14 years later? And it's $140. It's a 40% aggregate increase in the cost of living over time. So these percentages on an annualized basis, they compound in a very meaningful way.
Yeah, that's a cool example.
Well, I remember being at a Nick Murray seminar back in the early 90s, the educator of financial advisors, and he said, just hold up a stamp on an index card to show the compounding effect of inflation there. So I just looked it up. The stamp in the early 90s was 42 cents in Canada, and now it's $1.07.
Wow. Yeah, that's another good example. So anyway, two good examples to explain why it's important to think in terms of real returns, not nominal, which makes the whole topic we're talking about hilarious also, right? Because, yeah, you're going to get 10% a year. Okay, like 10% nominal returns. What's the real return? What's your inflation assumption? That's what we should ask the people saying this maybe. Okay, so to flip those U.S. stock returns that I mentioned a minute ago into real terms, from 1950 through 2023, the real return in U.S. dollars was 7.63%, and then for the last 20 years it was 7.16%. And I'll come back to this later, but like when people say, 10% return is what you should expect from stocks, what they're really saying, based on the historical data, is you should expect about a 7% real return. So we'll talk more about that in a minute. And that 7% or higher in those two examples is still exceptional. It's even exceptional for the U.S. market. I find this super interesting. So from 1900 through 1950, U.S. stocks returned an annualized 5.57% real. And that's a lot closer to what global stock returns have been from 1900 through 2023. I'm going to dig more into this more in a minute, but basically U.S. stock returns post 1950 were exceptional relative to pre-1950 U.S. stock returns and relative to global stock returns. So it was this exceptional period on many different ways of measuring that. So I think the big question for investors thinking about or hearing that they're going to get a 10% return is whether that pre-1950 sample, U.S. sample, or the post-1950 sample is more relevant for thinking about expected returns, for thinking about the future.
So that's the argument I always get, is the market's different now. Back then it was very difficult to invest. It was only for the wealthy. Nobody owned stocks back in the 30s and 40s. Now you can buy stocks with 3 clicks, from your cell phone. The dynamics and the fundamentals of the market are totally changed. So the pre-1950 period is not something we should put any weight on. I don't know that that's true or not, but that is the pushback that I get every time I talk about that.
But is the perception that stocks are riskier today or 50 years ago?
Well, it's not even that. I think like I'm glad you brought that up, Mark, because I've seen the same thing. But they get it backwards. That is completely backwards. The fact that it's easier to invest in stocks today and that the market is arguably safer than it was back then reduces expected returns. It doesn't increase them.
Exactly.
Yeah. And we'll see that there's research on this that we'll talk about in a minute. The market has gotten safer, or it's perceived as being safer over time, and it's easier to invest. People have more access to financial markets. More people can invest. All of those things drive expected returns down, not up. Mm-hmm. They drive realized returns over the period up because valuations increase as markets get safer or more accessible, but that drives expected returns down, not up.
Well, and financial risk has been around for thousands of years in some form or another, and a lot of this is just behavior, right? It's what type of return do I need to be earning to be compensated for the risk that I'm taking. So yes, maybe the technology is a lot different, and like you said, with that comes higher valuations and potential for lower returns, but the concept of risk on your money is not new, right? And I don't know that humans have changed all that much in terms of their behaviors and psychology over that period. So I agree with you that we shouldn't discount that period in the past just because technology is different now, right? Or there's more participants now.
Well, yeah, if anything, it's backwards. If anything, that period where there was broader adoption of stocks, that period had higher realized returns because valuations went up. But that means expected returns are now lower.
Mm-hmm. Exactly.
Yep. So I'm really glad you brought that up because it's a super common counter argument to discount all of the historical data. But I mean, the other thing about that is, okay, what about the rest of the world? Why do we ignore all of the other countries other than the U.S. for the last since 1950? I don't know. I haven't used that counter argument on Twitter yet.
But all these countries, people are still making decisions to buy and sell. So how can the dynamic not continue to other parts of the world? It doesn't make sense either.
Yeah, I mean, well, yeah. The real returns have been pretty consistent. Real stock returns have been pretty consistent for a very long time, other than like the U.S. being the big exception. Australia's done actually a little bit better than the U.S. since 1900, but nobody focuses on that. People just care about the U.S. doing
the
so
Australians do. I'm sure the Australians focus on that a lot.
That's very possible. Well, even Canada, like Canada and the U.S. were neck and neck for a very long time, and it's just relatively recent history that Canada's stock returns have not been as strong, and the U.S. has been crazy. But okay, so a big reason for that though is rising valuations on U.S. stocks. So we alluded to that when we were talking about more people adopting investing, all that kind of stuff. That would get reflected in rising valuations, and that's what has happened in the U.S. market. From 1950 to now, U.S. stock valuations went up a ton if you look at the Shiller CAPE ratio. And that's a component of returns that I don't think investors should count on repeating consistently. You shouldn't expect valuations to increase forever, which doesn't make sense. Valuations are like the closest thing that we have to gravity in financial markets. It's obviously very, very different, and it's not actually like gravity, but it's the closest thing.
Can you just explain that, like the increase in valuations, like what that means? Like, because you'll hear people talking about multiple expansion and increasing valuations, and what they're really saying is that people are willing to pay more for the same stream of future cash flows on a stock, right? So stocks are more expensive. I think for a lot of novice investors, that just means they're going up, which to them is a good thing. But what you're saying is that if you hold future cash flows or future profits or earnings of a company stable, price matters. And if you're going to pay a lot more for a stock for that same level of cash flow, then you should expect lower returns. Is that right?
Yeah. So I'm thinking about the Schiller cyclically adjusted price earnings ratio, which is the price relative to the 10-year smoothed real earnings for the companies in the index. And so over this period, 1950 to now, it's exactly what you said. The price that someone's paying per unit of earnings, I guess, has increased quite significantly. So people are paying more for the earnings of U.S. companies, much more than they were 70 some odd years ago.
And I would suggest that the awareness of that fact is probably not that broadly held.
Based on the amount of interest people have in investing in the S&P 500, yeah, I think that very few people, especially casual investors, understand that.
Yep. Well, and they'll always invoke Warren Buffett in these arguments, right? Because Buffett's always said, like, just go buy the S&P 500. Yeah. But Buffett is a value investor, right? And so it's funny in the same conversation to hear somebody talk about that, because they're really talking about the Warren Buffett style of investing, which is buying cheaper stocks. And at the same time, what you're saying is a lot of the returns have been driven just by stocks getting more expensive.
Yeah. I mean, Buffett and Bogle both said just buy the S&P 500, which has been pretty good advice historically. But I mean, we're going to talk about why, not even why that would be bad advice going forward, but why the realized returns of U.S. stocks maybe just aren't representative of what their expected future will be like. So Fama and French actually had a paper on exactly this, on whether pre or post 1950 returns are more representative of expected returns for U.S. stocks. So this is a 2002 paper, and their post 1950 sample only goes to the year 2000. But if you look at like valuations in the U.S. market, they're actually kind of similar today as they were when the paper came out. So I think their arguments are still worth hearing. So their approach in this paper is to estimate expected stock returns using dividends and earnings, and then they use that estimate of the expected stock return to judge whether realized returns over a given period were low or high relative to expectations. And so what they find is that their expected equity risk premium for the period 1872 to 1950 is very close to the realized average equity risk premium over that period. But then the 1951 to 2000 realized risk premium is almost 3 times the estimated premium. So the paper is basically suggesting that the earlier period, 1872 to 1950, delivered on expected returns. You got the expected return, which should form expectations about the future. But then the later period delivered unexpectedly higher returns. And those unexpected returns, I don't think, are something that investors should count on when they're setting expectations for the future. And the paper basically finds that it's attributed to rising stock valuations. So discount rates over the period fell, expected returns fell, which caused valuations to increase. It's exactly what we were talking about. Earlier. So I think that rear view mirror bias idea, that when you look at past returns that have been high on the back of rising valuations, can be really misleading. Context about why did those returns happen matters a lot, and that's where looking at what happened to valuations over that period becomes important. Okay, so there's a more recent paper from Jules Van Binsbergen, who's been on the podcast, and a few co-authors. So they suggest in that paper that survivorship bias probably contributed a lot to the historical U.S. equity premium. It's the kind of this known thing in financial markets that the longer a market survives, the higher its return will tend to be. And that's the argument is representation of survivorship bias. And a lot of that's just luck. Like there's stuff has not happened in the U.S. that could have happened and stuff that has happened in other countries, but hasn't happened in the U.S. Not because it can't happen, just because it didn't. It hasn't. And so that's the survivorship bias piece. But then the other component in this paper is that they talk about how the fact that hasn't happened, that the disasters haven't happened, has allowed investors to learn or perceive that the U.S. market is increasingly safe. So the more time that passes without a major disaster in the U.S., the safer investors perceive the U.S. market as being. And so that they refer to that in the paper as learning about the safety of the U.S. market. And that, again, similar to what we were talking about earlier, that drives down the discount rate. And it's a different, that's learning, but we were talking about more access to markets, which I think is also a valid point. We've got all these various pressures pushing down discount rates for U.S. stocks, which pushes up their valuations. So they find in this paper, using a bunch of interesting modeling techniques, that when you take those two components, survivorship and learning, valuation increases, they explain about 2% of the historical U.S. equity risk premium for the period 1920 through March 2020, which is the data they were looking at in their paper. And
that's 2%. That's an annualized number, right? Like 2% of the annual
correct
returns. Yeah.
Yeah. Yeah. So that's I think one of the things, and it's similar to the one you raised earlier, Mark, about how people have more access to markets and stuff like that. The U.S. market has historically been like the place to invest, the best place. That wouldn't have been obvious at the beginning of the period, like in 1920 or 1900 or whatever. But it's very clear now, looking backward, that this has been the best place to invest. And it is still an incredible market. Like, there's no denying that. I'm not arguing that at all. But the thing that matters to investors is to what extent is that reflected in market prices? Like, we know U.S. stock valuations are high. We know the U.S. market is amazing. We know it has been amazing. And we know it still is amazing. But everybody knows that. That's not a secret. And so we see really high.
Will it be more amazing? Will it be more amazing than expected?
Well, that's the question, right? When you just take the Shiller earnings yield right now, take the inverse of it. Or sorry, the Shiller earnings yield is the inverse of the cyclically adjusted price earnings ratio. So take the inverse of the CAPE ratio. That gives you an estimate of the real expected return, the real discount rate that the market is pricing. That's around 3% right now, a little below 3%. So the real return
returns,
being the real expected return being priced into U.S. stocks is about 3%. So for future realized returns to be higher, there's got to be more good luck or more rising valuations or some combination, which could happen. I'm not saying that it won't, but on expectation, you wouldn't expect a 7% real return.
You mentioned 7 real earlier, and you said the multiple expansions added 2. So that's a lot of multiple expansion to get to that 7 from the 3. Am I correct? Just to make this real simple.
Well, the 2 and so the 3 is the current expected return. If you look at current, like a lot of future multiple expansion.
Yeah. That's what I mean. To get from the 3 to the 7, which explains the 10, that's a lot of 2s to get there.
I agree.
You know what I mean?
Yeah. So it's got to be a lot better than expected to see a repeat of historical performance.
Yeah, I agree. The unexpected portion of returns going forward has to be a lot higher than it was in the past for future returns to be similar to past returns.
Mm-hmm. Which can only be explained by surprises, essentially.
I agree. Yeah.
Right? Which is the hilarious part of all of this.
Yeah.
Is that it's the only way to repeat this is to have things that people don't see coming.
Correct. Which is what has happened for the last, throughout history. The U.S. has continuously been surprisingly amazing, but it has to continue doing that. And we see that, everyone knows how amazing it is now. We see that in U.S. stock prices. But things have to be that much better going forward. So if we take the 2% out of the historical return over that period, 1920 to 2020, netting out the 2% of unexpected return gets us to 5.28% real annualized over that period. Now that number is a lot closer to pre-1950 U.S. returns. It's also a lot closer to global returns, which we'll talk more about in a second. Now, I do want to be clear that I'm not suggesting that we just throw out U.S. historical returns. I think eliminating outliers is about as foolish as focusing solely on them. Maybe not quite as foolish. But still, I think it would be a mistake to just say, well, we don't like what the U.S. data shows, so we're going to ignore that. But an alternative approach is to broaden the scope, look at more data outside of the U.S. Focusing on this one outlier in the best period, I don't think makes sense. We know that U.S. stock returns have been high enough to be deemed a puzzle. There's this well-known thing in academia called the equity premium puzzle. It's basically like stocks returns in the U.S. have been too high for the amount of risk investors have taken for owning them. And so one of the ways that some researchers have tried to address the equity premium puzzle is looking at global stocks. We know the U.S. has been an outlier, so is there an equity risk premium puzzle outside the U.S. or globally? So if we look at global stock returns from 1900 through 2023, excluding the U.S. market, real returns have been 4.35% annualized in U.S. dollars, or 5.16% if we include the U.S. market. So again, that number, 5.16%, is pretty close to the 5.28% if we net out the unexpected portion of the return from 1920 to 2020. And then there's the Scott Cederberg research where they look at 38 developed markets with data for some countries going back to 1890. And then they use block bootstrap to simulate returns over a 30-year period. And so that gives them a range of returns. But if we just take the median of their bootstraps, the median annualized return for international stocks was 5.28%. And for domestic stocks, it was 4.78% in real terms. So again, similar to that 5% real range. Now that 10% return that we're kind of addressing in this segment, remember that's roughly equivalent to a 7% real return. And that 7% is about 2% higher than unbiased estimates of U.S. expected returns. And that comes from the Binsbergen paper that we talked about. It's about 2% higher than U.S. equity returns before 1950. And it's about 2% higher than global stock returns for the period going back to 1890 through 2023. So I think assuming that the best historical period for the best performing stock market, assuming that's going to persist in the future and basing your financial planning on that, especially when valuations in the U.S. market are suggesting a 3% real return expectation, I think that's kind of crazy. I think it's kind of ridiculous. And I think that the people who are repeatedly spouting this information and who don't back down when you present information like this, I think they need to learn a little bit more about market history and valuation theory. The way we do this, though, because we have to do this at PWO, we give people financial planning advice, so we need to have expected return assumptions. We take the global historical return from 1900 through 2023. We net out the return over that period from valuation changes, and then we account for current valuations using the earnings yield for the different markets that we're looking at, which is U.S., Canada, and international and emerging markets. And then we combine all that together, and that gives us a real expected return for a globally diversified portfolio with a Canadian overweight of 4.62% real. Or if we apply our 2.5% inflation expectation, that's a 7.24% nominal expected return, which is a lot different from 10%, but I think it's a much more reasonable estimate.
Mm-hmm. The other thing I think investors fail to remember or understand is that it's actually really difficult to just capture the market return as an investor, right? So like we're talking about index level performance over certain periods, and fees are, maybe near zero now for do-it-yourself investors using, broad market ETFs. But humans are still humans, and they're subject to all sorts of biases and behavioral errors. So as an individual, unless you're incredibly stoic and have gone through like multiple bear markets and know exactly how you're going to react to adversity in the market, to assume that you're going to capture the return of that market, even if it is 10%, I think a discount needs to be applied there, or at least some buffer to the assumptions, because investors notoriously and advisors are subject to biases too, but people have difficulty capturing returns. It's very easy to observe these returns in hindsight and just plot it on a graph. It's much more difficult to capture those returns live in your portfolio.
It's interesting you mentioned being a stoic. That's a big message in Scott Galloway's book. We got Scott coming up in a few weeks on the pod, but that is a huge part of his book, is to really be a stoic about investing.
Mm-hmm. Yeah, absolutely.
Yeah, it's an important point that you got fees, taxes, and there's a behavior gap of like, if you look at the data, it's 1% or higher. Mm-hmm. One other thing I want to mention, because I see this come up a lot when I have discussions about this online. People say like, well, why are you looking at data for a 124 year period? I'm not going to be investing for 124 years. That's not the point. You don't have to live for 124 years for the return over that period to be relevant to you. The idea is that the longer, a large sample of data gives us a more unbiased estimate of the expected return. And to illustrate that, I mean, I think, well, one of the data points we mentioned does this explicitly, but if we took the data that I've mentioned for that 1900 to 2023 period, if we split that up into 30 or 50 year chunks and just looked at rolling 30 year or rolling 50 year periods and then took the average of the returns over all those periods, it would be pretty similar to the full period return. I've played with that. It's usually pretty similar. But then even more explicitly, the Scott Cederberg research is explicitly looking at 30 year bootstrap samples, and we're looking at the median 30 year compound return. So that's just it's a funny thing where people want to discount the historical data because their time horizon doesn't match the horizon of the historical data. Mm-hmm. But I think that completely misses the point of why we care about long-term data. The idea is that it gives us a more unbiased estimate of what expected returns are. Over
the
any
other
period.
thing I hear a lot of is that the data I don't know what date you want to pick, but like pre-1930 isn't good. Like there just wasn't a lot of data, and especially prior to the 1900s, right? Like I know you guys have gone back with the one single French company to like the late 1600s, and it's one sample, sure. But one of the arguments there is, well, the data pre this period, and pick a starting date to cherry pick from, there's not enough data. It's not good. We can't trust it. So the 1950 period onwards is much more reliable because we had better data. It's more accurate, and there's more of it. I don't know if you have opinions on that. I don't know enough about it, but it's a common complaint I hear.
Yeah, so we asked Scott Cederberg about that when he was on, and his answer was basically that if you look at the characteristics of the return experiences over the historical periods, you can split it up by pre or post whatever time period. What their observation was that the things like drawdowns and recoveries and volatility and average returns, like all that kind of stuff, are relatively stable over time. So stuff changes, like the world changes, technology changes, and all that kind of stuff. But it's like what you said earlier, Mark, the people are ultimately what are driving asset prices. And that behavior, that the asset pricing, seem to be pretty consistent over time because the characteristics of returns are pretty similar. So we could say that the quality of the data in the earlier period is bad, but it looks a heck of a lot like the data in the later periods. So other than the fact that U.S. valuations have increased and driven their stock returns up. But if you look at other characteristics of the returns, they've been pretty consistent over time.
It's amazing.
So the idea that the quality was poor back then doesn't seem to hold a whole lot of water. I think if we saw like drastically different volatilities or drawdowns or some other characteristic, then we would have to seriously consider whether those data are useful. But the consistency over time, I think, should give us some level of confidence that the historical data are pretty, at least good representations of how assets are priced over time.
That's interesting. There's something you said earlier, and I just want to make sure I understood it correctly. That even after adjusting for the unexpected returns in the U.S., the historical returns, the adjusted returns of the U.S. were still marginally higher on a real basis than the returns of global stocks in those 38 developed countries. Is that right?
Yeah. So we took the return from 1920 through 2020, which was which gave us 5.28%. We netted out the 2% return.
Yeah.
So it's a bit of a different time period though, because then we have 1900 through 2023. The global ex-US return was 4.35%.
Okay. Does the unlucky events from certain countries drag that down, right? Like you're comparing a very lucky situation with the U.S. and basically them avoiding certain catastrophes that other countries did face. But you had catastrophes in Germany and in Japan with their markets, and China, and that must, I'm assuming, bring down that historical average, right? And so comparing a single very lucky market to 38, developed nations in aggregate, where some of those who had high weights in the global markets experienced really, really bad outcomes, drags that average down as well, right? Because I can just see listeners going, well, even then the U.S. marginally outperformed. But a lot of that, I think, is because the U.S. got lucky and other countries didn't, right?
For sure. And Japan is always, I don't know if it's the best counterexample, but Japan is always the counterexample to the U.S.'s success. Because there was a time when Japan made up a huge portion of global capital market, as the U.S. does now. And it didn't work out so great after sort of 1990. Japan was massive and economically powerful. And then it since then has struggled. Its capital market has struggled for sure. So it's not a guarantee that the U.S. will continue to have the good fortune that it's had historically. But yeah, I think that's a great point, Mark. In that sample of non-U.S. countries that have a lower realized return, there's a lot of stuff that just didn't work out so great.